Hello, everyone. Thank you very much for joining us on this incredibly wet and windy day. We're really delighted to be working with Investec on this series of Investor Academy sessions. And I'll hand over to Camilla shortly to introduce today's session and today's panel. But very quickly, for those who haven't met me before, I'm Sarah Turner, co-founder of Angel Academe. Angel Academe is an angel network. We invest in female-founded and co-founded startups. We've recently hit the milestone of 40 companies invested in so far. And we also introduced more women to angel investing. When we started in 2014, there were only a tiny number of women investing, and the Investec and the networks that I was part of really didn't deliver what I needed or what I thought other female investors needed. So Angel Academe was created specifically with women in mind. We're very structured and organized because women don't have much time. We're thorough because women are aware of the risks, and we're collaborative because that's how we become better investors. And crucially, we invest in female founders because they're still underfunded and underserved by the investor community, especially when they're operating in less female areas like fintech or clean tech or enterprise software. But we aren't just for women. We have men investing with us and some great organizations supporting our mission, such as Investec. And on that note, I'm going to hand over to Camilla Sherbrooke from Investec, who's co-hosting today's event with me. Over to you, Camilla.
Thank you, Sarah. Hello, everyone. My name is Camilla Sherbrooke, and I'm going to be chairing this afternoon's panel. I'm an associate director at Investec Wealth and Investment, where I manage portfolios on behalf of a range of different clients, as well as providing advice in relation to estate planning and retirement planning. Today, we have a fantastic panel of three female colleagues of mine. Welcome to Sandra, Stacey, and Hannah, who are from various different parts of Investec. I will ask them each to introduce themselves at the start of their presentations. Today, we shall be discussing the economic implications of COVID. What are the risks? What are the opportunities? And looking forward, how can we as investors position our investments accordingly? I have a few questions to ask the panelists to kick off the Q&A, but please do post your questions in the chat, or if you would prefer, do raise your hand. So Sandra, can I please ask you to switch on your camera and take the floor?
Of course, thank you very much, and good evening, everybody. It is very nice to be speaking to you tonight. I'm one of the economists in the team at Investec. We serve the different parts of the business, and I'm very excited to be speaking to you and introducing a little bit of our thinking on the global economy. Now, what I would like to do, I have prepared a number of slides here that I would like to show to you. I'm not trying to be too intensive on the slides, but I thought it would be useful to frame the discussion a bit in terms of a few pictures of where we stand and where we've come from and where we're going on the economy. So without further ado, let me start slideshow. So we titled this event, Economic Case Closed, but at what cost to UK entrepreneurship? On the economic case being closed, I think the first thing to look at is what has actually happened and what period we've gone through. This is a chart that shows global GDP growth in real terms, and it compares the current pandemic experience with that of the global financial crisis. The pandemic line is the level of GDP that we've experienced, and the sort of pre-crisis point is indexed in both cases to 100. So just to give a sense of the scale of this recession, beforehand, everybody said the global financial crisis was a huge recession, and it certainly was in the recent historical context. Well, COVID has completely dwarfed all of that by the sheer scale of the fall in output. However, quite unusually, although the scale of output was so deep, the recovery since then has been faster than the recovery was following the global financial crisis. So even though we've reversed 18 quarters worth of previous GDP growth, as opposed to 9 quarters last time around, we're already out of it at a global level, at least. So it's been not only a deep, but also a short-lived recession. How come? What has been the main difference or the main factor here? I guess, first of all, last time around, we had a financial crisis, and academic research has shown that those tend to be particularly deep and long-lasting. This time, thankfully, the financial sector has come out of this very well and not perpetuated risks. The second and perhaps linked difference is this time the government has stepped in a huge fashion. We've had intervention across the globe with governments coming in different forms. We've had monetary policy support, so lower interest rates across the board, but we've also had a lot of spending being targeted, in particular to avoid the labour market deteriorating sharply. The form this has taken has been quite different if we look at different countries. So, for instance, in the UK and in the Eurozone, there have been forms of furlough schemes whereby companies were paid to keep existing employees on. The US has taken a very different approach. Instead of giving the money to companies and maintaining those relationships, they have given money directly to households. So that has supported consumer spending more directly, but in a different way. The end result has been that unemployment, unsurprisingly, has shot up far more in the US than it did in Europe. But at the same time, it has also come down very steeply there. And there are pros and cons to doing it either way. Perhaps these ties have been maintained more easily in Europe, but perhaps the US approach has been more nimble and adapted to changes in structure somewhat better. Now, what else has happened with this change in the economy? I guess, first of all, as we said, there was a lot of government support that has helped household incomes stand up very well. This is clearly not what normally happens in a recession. And that has really helped household consumption to hold up. There has been a huge rise in the amount of household savings that have occurred. In the UK alone, we estimate that £163 billion more than normal were saved during this recession. That's a lot, as much as 7.6% of GDP. It gives a huge cushion to economic outlook going forward. If all of this were spent, this could be absolutely transformational in terms of GDP growth. That's highly unlikely. It's probably likely that households will hang on to this and only use part of this. But some of it has gone into assets and investing, and some of it has found different uses and perhaps will be spent later on. So this is a big cushion, which also will help, and I'll come back to this later, absorb some of the price rises that we've seen. The second outcome, though, and this is what this chart shows, is that there has been a big change in the pattern of spending that households have had. It's quite remarkable. This is a UK chart. I could have shown charts for other countries too. The same story applies. Consumer goods spending has held up remarkably well. Yes, there was a small dip as we went through 2020 in some parts, but on the whole, consumer spending on goods, and these are volume figures, has been slightly higher now than it was before the pandemic. Services, on the other hand, took a big hit and a big tumble in terms of output, and we're not back where we were, even though we're heading in that direction. Overnight, practically, there was therefore a big shift in consumer demand away from services and into goods. This has been very difficult for supply chains to deal with across the globe, especially in cases where we've had other issues that have come about, such as COVID directly impacting shipping and logistics, etc. The UK, perhaps that has been compounded even more by issues such as Brexit. So these sorts of issues are causing frictions and mismatches between where consumer demand is and where production was pre-pandemic. So it's not terribly surprising in this context that with the resilient labour market and this change in pattern, we've had a big rise in global inflation. Now, what explains higher inflation, as we've all seen recently? It's very hard to tell, and it's very hard to disentangle exactly what is behind this. This chart attempts to replicate something that was done by the Bank of Canada, where they've tried to say, well, some factors are to do with supply chain disruptions, problems in procuring certain inputs, semiconductors, etc. Others are more pockets of strong demand, and that is seen in certain other sectors. On top of that, we've had a big rise in energy prices at the same time. So this has been an attempt to break down, this is for UK inflation, how much of this can be attributed to these various factors. And the answer is all three of them have made a fairly major contribution to the overall uptrend in inflation that we've seen. It really has been spectacular so far. And unfortunately, it doesn't look like it's over yet. If we're looking into next year, certainly energy prices are likely to get a further boost once the energy price cap is lifted again. The next rise is coming in April, and that will be reflected in yet higher inflation. So we could be looking at inflation close to 5% or so in aggregate by the time we are in the spring. And this is clearly something that the global economy hasn't experienced for a long time. And the UK is certainly not alone in this overall experience. Part of the energy price story, and I'm sure others will touch on this, is also to do with politics and also with the energy transition in ESG. That may be perhaps something that could be more sustained rather than just a temporary factor, such as supply chain disruptions that will hopefully self-correct to some extent, because of course, in pockets where price rises have been particularly large, more companies are encouraged to produce more, and that in time should help inflation come down again. Overall, therefore, what economists have seen over the years, and this is a chart that shows really how the inflation forecasts have evolved for different countries over time. These are so-called consensus surveys, so they take a number of reputable sources and aggregate them and see how their forecasts have evolved through the year. On the left-hand side of this chart, it just shows that in general, as inflation numbers have crept up, so have aggregate inflation estimates for the current year's inflation rate. Most clearly, the US stands out in having had a very large spike in inflation there. But perhaps more concerningly is what has happened to inflation forecasts for next year. Of course, we don't have any data on that as yet, but there's more and more concerns that what we're seeing now isn't just a temporary factor that will go away very quickly, but perhaps something that could last for longer. And if we think that by and large, central banks target inflation of 2%, that's true in the US, the UK, of course, the Eurozone, and with the sort of inflation rates that we're looking at next year, it's not clear that the inflation mandate that central banks have is being met. What does this mean? Well, if inflation is here to stay, and it's not just a very short-term effect, as policymakers are also starting to worry, then perhaps it's time to act. That means it's time for rate rises. Why do policymakers not react now when inflation is so high now? Well, unfortunately, it takes time for price rises to be affected by what central banks do with interest rates. And so for the time being, the story has been that, well, inflation pressures are temporary, perhaps they will subside, and that will give, it doesn't make much sense to raise interest rates now, because by the time it takes effect in 18 months or 2 years from now, inflation will be back at target and there's no need. That story is starting to change in light of the tight labor markets and in light of the potential wage pressures that are coming about. So with this overall picture, we're looking at expectations of interest rate rises coming pretty quickly. Now, of course, the economic case being closed depends very much on numerous factors that are outside the control, Omicron being one of them. But if Omicron doesn't derail the picture considerably, it is likely that we'll see interest rate rises very soon. That could be as soon as even next week, perhaps in the Bank of England's case, or maybe if they decide to wait for some more information on how Omicron is turning out, it will be early in the year. But on the whole, we're looking at interest rates taking a rise, perhaps by the end of the year in the UK by the end of next year, that is, to 0.75%, and further interest rate rises to come. We also think that the other central banks will follow. The Fed in the US will probably start raising interest rates from the middle of next year onwards and go relatively aggressively from there on. In the Eurozone, that shift is perhaps a little bit longer yet to come. The ECB will take some more time to be convinced that inflation is here to stay after a long period of undershoot. But generally, the tide is turning, and we're looking at a higher interest rates environment going forward. Where does all of this leave us from the point of view of entrepreneurs? I think one key question on the demand side that comes out of this, given the shifts in the consumer patterns that we're seeing, is how persistent are these changes in the demand pattern going to be? Is everything going to go back to the old normal, or are we going to reach a new normal? And that sort of change of patterns of consumption leaves perhaps less predictability. On the other hand, it does leave opportunities for entrepreneurs to deal with this new situation and try and find the right market for their products. So in that sense, it's an exciting time going forward. On the supply side, what does this mean? Well, if we're looking at a higher interest rate environment, funding costs for companies could be higher going forward. And that's something that will increasingly have to be taken into account, we think, no matter where companies operate. A further consideration is perhaps, in light of these uncertainties, will there be the need to hold higher stock levels than have been held in the past? That obviously depends very much on the kind of product that company holds, but it's a consideration worth thinking about. And equally, where to position supply chains? Do these sort of disruptions that we've seen make it more attractive to perhaps pursue onshoring or nearshoring? Or is this still not attractive, especially in light of the tight labor markets that we're seeing? There are all questions out there, and the pandemic experience has certainly changed the picture in that respect. Further question, of course, is who will pay the bill for all of this? I said it hasn't come cheap to support households through this period. We're seeing some tax rises coming already in the UK. We will have a national insurance rise coming, and in the form of the health and social care levy. We will have corporate tax hikes coming before too long. More generally, will, by the time the next recession comes about, this sort of more interventionist approach by governments come back again, or will we be more orthodox in light of the mounting debt that we're having? All of these are very interesting times, certainly, and I look forward to witnessing it all and hearing your thoughts on this.
Sandra, thank you. I find it particularly interesting to see visually on the second graph how consumer spending patterns have changed. Given that supply chain constraints have been a significant contributor to higher inflation, do you think that monetary policy is an effective tool for controlling inflation? And if not, what other tools do central bankers have in the toolbox?
I think it's a very good question. The first point to make is that central banks can't do very much about supply chain disruptions. It's impossible to address these underlying issues there. Really, the private sector will have to sort this out itself over time, and price rises, by giving incentives to spend in certain areas and boost production where there's particular demand shortages, will be part of the answer, just not quite yet. That said, this self-correcting element only goes so far if we're operating in very tight labor markets. And that is where the concern is that the central bank does have to step in. And yes, it's longer, perhaps once we get wage pressures in the system, will have enough cost pressures that may last long enough that, yes, at that point, it does make a difference what the central bank does with interest rates. And therefore, they should step in. So it's not so much the immediate factors that central banks can do something about, but it's the labor market and preventing these wage price spirals that they can do.
Brilliant. Thank you very much. Stacey, I'm now going to pass the mic over to you.
Thank you very much, Camilla. It's lovely to be here. I'm Stacey Parrinder-Johnson. I'm the Chief Investment Officer of Investec Wealth here in the UK. I have been with the company for 16 years, and I previously covered thematics and private equity. So I used the same first slide just for this one. So if we just pop to the next one, please, Sandra. Oh, Sarah, sorry. Perfect. So what I've done is trying to cram as much information as humanly possible onto the screen. And I wanted to talk a little bit about what's happened in 2021. And because this is a female-led event, I've picked two of my favourite singers, and the first one is Tina Turner. Is Tina simply the best? So Tina stands for There Is No Alternative. And this is something that we've been hearing in the market for the past couple of years, really. And what that does is it reflects the idea that in a low bond rate environment, equities are much more attractive to hold. And we've seen a return from the MSCI ACWI index, which is the general global index of equities, of 17.5% this year. So really, really positive price rise there. So it was driven by those low yields. It was also driven by the fact that we had some really strong thematics in the market that continued to play out. Digitalization, and at some point during the year, we started talking about reflation as we rotated into what's called the reopening trade, as we saw that. So really, really strong returns from equities. But when we talk about equity markets, essentially, we're talking about really huge companies. This is always the bit that I find interesting, especially when speaking with entrepreneurs, because the median company size in that index is £6.5 billion. The market is absolutely dominated by some large tech firms, you know, the Apples that we're really familiar with. And so there's a little bit of a disconnect, I think, when we're talking about what's happening in what entrepreneurs are doing and what we're seeing in the financial markets. Interestingly, on one side you have those large tech firms, but on the other we have a really big question at the minute about what's happening to old industries or more traditional industries such as oil and gas. You know, we've seen energy having serious price rises recently, but really when we're looking at them as investors, what we're seeing is that there is a tailwind from investors such as Investec asking questions about how sustainable those returns are, given what we know about ESG, which is the environment, social and governmental aspects to investing in those companies. And a really, really interesting question I think that investors are starting to ask is, what do we actually mean when we say we want to get ahead of the curve in investing? You know, expectations are pretty much always in the market, but what we're trying to do is get ahead of those expectations to see what comes next. So one of the things that I would really like to draw everybody's attention to, probably obviously since I said I cover private equity, is the return of UK listed private equity fund of funds, which is 30%, so more than that return of the general global index. So this is actually a reasonably concentrated list, so probably about 7 or 8 in there, but they give a really good example of how people are thinking about smaller companies and how sentiment is around those. Why do people want these? You know, why has the return been so much better? Well, firstly, it's because by accessing smaller companies, you get access to emerging thematics. And secondly, you get access to capital light digital winners. So those two are really, really quite linked. You know, a lot of the themes that we're seeing now, even if they're in areas such as healthcare and financials, are actually being driven by the digitalization of those traditional sectors. So, you know, we've seen telehealth, for example. We're seeing real strides being made in things like insurance tech, and people want to get access to these, and they're not really that easily available through a really large cap index such as the ACWI. But what I think also is very attractive to investors is that the majority of private equity holdings could potentially be seen as sustainability focused because they're small companies trying to make a difference. They can have very, very good reporting, and they can be very inclusive. They've got much more control over the people that they hire into those businesses and how they treat them. And we're seeing real strides being made in how reporting is happening in smaller companies. If we could move to the next slide, please. I think what we actually really need to do, this is where I want to spend most of my time today, and that's speaking about 2022 and beyond. And I've put, do we actually believe, like, share? And it's probably giving you a horrible insight into what's on my iPod. So there's a really brilliant piece of work, and it's being done by King's College London. I would urge you, we've got the link, we can send it out. It's a really great piece of work that talks about entrepreneurs in the pandemic. And what the results from that showed is that 40% of entrepreneurs said that they saw new business opportunities in the pandemic. So when we say what are the risks, we know that there have been definite hard times for smaller businesses, for entrepreneurs, but actually there have also been a raft of new things that have been thrown out, coming back to those digital opportunities and the changing tastes of consumers. And you can see that in the types of businesses that have been set up, in what we do here, that we've got some very agile businesses. When you haven't really got that many people working for you, when you're very capital light, you can pivot towards those opportunities a lot better than a big super tanker business can. And what we're seeing is the continuation of that digital acceleration to more and more different types of businesses and different types of services. So one of the other things I think that I would draw your attention to before I'm talking about the things from that report is that there's a really brilliant bit at the end that talks about how you build emotional resilience as an entrepreneur. And I haven't put it on the slide here, but I think it's really important in that in order to be an agile business, in order to be able to go out and find those opportunities, actually entrepreneurs have to be good in themselves and to feel positive. And obviously it's been a very, very difficult environment, and this report actually gives something like 5 different recommendations as to how to build resilience in entrepreneurs. So I would definitely urge you to read it. I didn't want to put it on this presentation, definitely wanted to mention it. Aside from just general well-being, the bit that fascinates me the most right now when I speak about the market is this idea of what I call memory, an experience and opportunity, and how those 3 things fit together. So if you look at the breakdown of stock ownership in the US, it's quite difficult to get numbers from anywhere else, but actually the Fed produces research that speaks to this. So 28.5% of the stocks in the US are owned by Generation X and Y. Y are the millennials. And why have I picked this statistic out? I think sometimes what we do as investors is we tend to take our own experiences and we look back and we say, how was it? And what has been my experience of investing? And what is my experience of the world? And we base all of our decisions based on that framework. We know that actually diversity is really important in challenging that, but fundamentally it's innate in us, right? That's what we do. What's great about the investment industry is that people always come along and tell you how much experience that they have. And we like doing it. We like doing these cumulative. We've got 3,000 years of experience. But actually, what that means is that there's a heck of a lot of old school kind of frameworks there. And the thing about Generation X and Generation Y that we forget is that if you've been in the market for only 10 years, really you've only seen low interest rates. Another thing is that you're part of what I call the connected generation. You know, I think I got my very first mobile phone when I was about 17 years old. I started using a computer probably around the same time, maybe slightly earlier. But we have grown up, and those generations have started to grow up with digitalization, with access to information at their fingertips, with a completely different experience online life than, for example, my brother who's in his 60s or my mum who's in her 80s, than they have. And I think that's really important, because when people say to me, is the stock market going to perform in the coming years? I actually think that we have to believe, and we have to look at what we believe. And if you've seen technology working, if you're living in an environment where technology is all around you, for example, of course you're going to say technology will continue. I think sometimes people who haven't experienced that sometimes can potentially think that this might just be a passing fad. The other thing is that those generations do search for impact in what they're investing in. So when I think about the types of businesses that we would like to own in the future, what we're going to start looking for is more evidence of how you can get impact from those investments, and the difference you can make of what these companies are doing. This is very, very important to investors nowadays. It's understanding what their investments are giving to them and what difference they make. And I don't want to speak too much about ESG, even though I mentioned it twice, but Ardian, it's a very, very big private equity company, has seen an increase in their queries about environment, social and governance related activities, 60% year on year for the past few years. Now, what do I think? I think in terms of early stage investing, I think that's a massive tailwind. Because, like I said, these earlier stage companies do tend to have more sustainable characteristics. They've got much more control. If private equity are planning on ownership, that's very good in terms of governance. You can have a big difference on governance in a particular company. It's also super positive for female investing. I know when I've gone out and I've analysed private equity companies, what they're looking for is themselves to try and get that impact and where they can put their money that makes the biggest difference, and what they can find is that next big idea. And I think that, female entrepreneurs are definitely something that these big companies, these big private equity companies are looking for when they're looking to fund the investments in their portfolio. So I think it's very nice to say that at the end of quite a tough year still, and one where there's still a little bit of uncertainty, I think we do have to believe, like Cher, I promise I won't sing, and look a little bit further to all the potential possibilities that there are in smaller investments. Thank you. Hi, Camilla.
Stacey, thank you. You've given us some really interesting stats and highlighted just how important it has been actually for entrepreneurs and businesses to seek out new business opportunities in the pandemic. Talking about opportunities, what do you think are the main investment themes that will prevail over the next 10 years?
So we identified 3 themes when we were doing a big piece of work. We spent 6 months looking at the different thematics that there were. I think at one point we came up with 83, but they fall into 3 main categories. And those are digital, which I've just spoken about, environmental, so definitely the energy transition, and then demographics. And I think what we're doing at Investec, which is a really interesting piece of work right now, is that we're working on our strategic allocation. So where we put our money in which bands, and the assumptions that we have for assets going forwards, and the returns and the risks of those assets. And what's been fascinating is trying to figure out how we look at things, for example, like female participation in the workforce, how we look at climate change, how we look at the impact of technology, and how we bring those into the assumptions that we're making about our investments for the long term. Those are definitely the 3 biggest areas.
Brilliant. Thank you very much.
Thank you.
Hannah, can I now pass over to you, please?
Thank you, Camilla, and good afternoon, everyone. My name is Hannah Goody. I'm a Director of Wealth Planning at Investec Wealth and Investment. And I'm going to talk today, taking sort of what people have said about, what Sandra said about the economy, what Stacey's talked about in terms of our investment process and entrepreneurs, and focus it in on, what our clients have been asking us over the recent months. And the number one question that we're getting at the moment is, what do I do with my cash? I mean, for years now, there has not been much of a return available on cash holdings. And these minimal returns are now being eroded away by high inflation, and we're actually getting negative real returns. If you were lucky enough to find a cash account that pays 0.5%, With inflation running at 4%, you're actually losing £350 on every £10,000 of cash that you hold. Now, obviously, people need cash for the short term. We have known liabilities, and therefore some cash is required. However, in order to protect the longer term, we need to invest in assets that offer returns higher than inflation, which will involve taking some risk. The other question we're getting asked a lot from clients is, what are we doing within portfolios to mitigate the risks of inflation of their funds? Well, we invest in multi-asset portfolios, which provide us with a number of levers to pull through different economic environments and different periods of time. The obvious loser at the moment within our portfolios is conventional bonds, where future cash flows are worth less in today's money and therefore the value of them fall. However, within this area, we can look to protect from inflation by using inflation-linked bonds, whereby the principal value, as well as the coupon from these investments, is linked to inflation and therefore does not erode your capital in the same way. We also invest in specialist infrastructure funds, many of which provide inflation protection built into their contracts. They therefore offer a long-term hedge against rising prices and have also historically proved to provide stability within portfolios in times of volatility. The main hedge against inflation is through real assets. We include an element of commercial property in portfolios, whereby both the value of the underlying property, along with the income streams, can provide protection against inflation. The value of the properties will increase. And again, contracts are generally written to have some form of protection within them. The bulk of our portfolios is, of course, invested in equities. These are probably the highest risk of the asset classes that we hold, but have historically outpaced inflation by a significant margin. In periods of higher inflation, equities generally tend to perform well. As the cost of goods and services rise, companies can make a higher profit. However, this depends on their pricing power and whether or not they have the ability to pass on to consumers rising costs. This varies very much between companies and between sectors. For example, a consumer goods company that has a strong and recognizable brand is usually able to pass on increased costs to their consumers. An example, extending to the luxury goods sector, Louis Vuitton has increased the price of handbags twice over the past 2 years without having much of an impact on their sales. In the other extremes, the telecom sector, the marketplace for broadband and telephone services is extremely competitive, and therefore companies in this area will not have much pricing flexibility and will have to absorb themselves any higher costs. Due to the disparity between companies and sectors, we tend to take an active approach to our investments in equities rather than passively following the markets. We can take advantage of market volatility and have a strict investment process that drives all of our investment decisions. Looking to the future, I think we will very much need to focus on what is driving inflation as much as the fact that there is just higher inflation. The implementation of carbon taxes is driving cost push inflation for a number of companies. Would it be therefore beneficial for us to invest our clients' money into carbon credit trackers? The drive to become net zero is increasing the demand for copper and battery materials. Should we therefore include a specialized commodities basket within portfolios? The aging population worldwide will lead to increased healthcare, and the rising middle classes in Asia and the Far East will drive inflation in financial and hospitality industries. Balance against all this is advances in technology, robotics and automation, which will generate deflation in certain areas. These are all factored into our investment process. Generally, for clients who are worried about long-term inflation, we advise that all of their long-term wealth is invested.
Hannah, thank you. Thinking beyond the portfolios and given rise in inflation, do you think that clients are becoming more concerned about the increasing cost of their future liabilities?
I think a big cost for a number of our clients, be it for their grandchildren or their children, is school fees. We've seen huge inflation in school fees over the last few years as it is, and a number of clients have come to us asking about what they can do about further rises in this area. We often help clients plan for such things with cash flow forecasting models. And using these models, we can adjust the level of predicted inflation and interest rates so that we can advise them on what they need to do of the cost of education in today's money and what they need to do to consider saving and planning for these future costs. I think in terms of planning, perhaps people being home more over the crisis, we're having a lot more inquiries about people's general wealth, about pensions, consolidating any pensions that they've got. Are they using all the tax efficiencies available to them, both with pensions and savings, and also estate planning? We've seen a number of clients coming forward and asking for just an overall review of the structure of their wealth to ensure that they're taking all the tax advantages that they can and making sure that their objectives are being met.
That's brilliant. Thank you very much. I think we should now open up the Q&A session to the floor. I'd be grateful if everyone could switch on their cameras. We've got a few questions that have come in already. Stacey, these two actually are for you. First of all, it would be great if you could give the name of the report that you mentioned.
Right.
And secondly, if you could share some further thoughts on the industry sectors of interest among private equity firms when they look at female founder-backed businesses, because Angel Academe are focused on the tech-biased businesses and STEM, finance, F&B. The question is, are we as angel investors providing funding in the right or mostly appealing areas for PE firms that are looking to take companies on to the next level?
So I think what I'll do is I'll pop the link to that piece of work in the chat box. I think that might be easier, and then we can send it out potentially afterwards. I think that might be good. It's a super long thing, so I'm not going to start reading it out. So I think in respect to the second question, I don't think that you can say this is definitely where we're looking for female founders. I think you can just speak more generally. There are three areas where I think it's quite interesting and we're seeing quite a lot of action. So number one is healthcare. So there are definite demands for healthcare and facilitated by digital. So that's where investors tend to be looking. The other one is just general digital software. I think that everybody's looking for the next best facilitator. The thing about those two areas, I think, is that is more of a B2B type thing that investors are looking for. So obviously it's really interesting in terms of what it does, but it doesn't give you those kind of big Elon Musk dreams, does it? And so the area where I think people do tend to get a little bit more excited is in consumer, because that's where you've got potentially that really big addressable market, potentially for your products ultimately, and that's another area. So the three are healthcare, digital software, and consumer, anything consumer.
Thank you. Please continue to post any questions that you have in the chat. I have got a whole question bank full of questions, so I'm happy to continue to ask mine, but equally, please do shout if you have any. This one, Sandra, is for you. Clearly, we're in the early stages of discovering more about the new variant, but do you think this will mean inflation might be more persistent than initially thought?
Two schools of thought really on this new variant. One is that it belongs to the supply chain disruptions that we were talking about earlier, and by doing so, by hindering the amount of adjustment that's happening, we will have inflation lasting for longer. And that's something that we're hearing quite a lot, especially from US policymakers. They're talking quite intensively about that. The other school of thought is saying, well, yes, but higher inflation along these lines. If we have variance that puts us back to not quite square one, but close to it. And we need to have we're again in a phase where perhaps the vaccines wouldn't work. What then? Well, then the question is, are we back to lockdowns and these sort of disruptions that will cause a big fall in output? And at that point, does the government step in again as generously as they did beforehand? Or are they saying, well, this is getting a bit expensive now, we'll do something, but it will be less generous than beforehand? If that were the case, and we were to get a rise in unemployment to much greater an extent than we've had beforehand, then there would be a deflationary impact. And I think we hear both of these arguments being put forward, and I think the answer is just we'll have to wait and see. So far, it's hard to tell which way this will go. My feeling is that the policy perspective seems to be more focused on supply chain disruptions, prolonging this for now, but the jury is still out.
I appreciate it wasn't a particularly nice question, given that we are in the very early stages of really discovering what this new variant's all about. But brilliant answer, thank you. We've got another question. I think, Stacey, this is probably aimed at you, which is, do you think inflation will have an impact on the amount of wealth being applied to VCP type funds now, or move it to bonds in any way?
So I think this is the part where we're talking about share, right? Where it's about what you believe in. Ultimately, inflation impacts longer duration assets, and by their very nature, the really big end of the index is longer duration, and also private equity, it tends to be in longer duration sectors right now. And what happens is when you price the private equity asset, you are using comparables. So I think that this is where that kind of, I suppose, that mindset takes over, which is, if you are someone who wants to invest in private equity, do you just go back on what you've seen over the past 10 years, which is that this stuff works and that this stuff is really, really exciting. What I think the difference is going to be is where people put their money is in the really high quality people. So I think investors like us, so I say we are the funders of the funders. Where do we put our money? We want to invest with really high quality private equity backers, and I think a lot of people are coming out, as you do in any market that gets popular, but really we're wanting to make sure that those standards are there. So I think that the more that you can make sure that the company that you're investing in is high quality and that is attractive to higher quality private equity people, to me that's the key.
Brilliant, thank you. Hannah, I've got one for you. Has your advice about the balance of cash, bonds, or equities changed, or will it do in the future?
Excuse me. Yes, I think absolutely it will. We always advise clients to keep a certain level of cash available to them for rainy day, as it were, any disasters that might come up. And I think that's definitely nearing the lower end of what we tend to suggest. Looking at bonds as well, back in the day when you could get a 4% income from your bonds, we definitely held a lot more in that area, not only as a sort of element of protection in portfolios, but also just because of the returns that could be generated from them. So yes, as market conditions change, and inflation's interest rates rise and fall, then we certainly do look at the various asset classes, including the cash that a client will hold, any property that they hold external to the portfolio, and do suggest alterations accordingly.
And that actually relates to what Stacey was saying in her presentation with regards to TINA. I mean, we're in a low yield, low interest rate environment.
Indeed. Yeah.
I've got another question for you, Hannah, whilst you've got the mic. Is there a way to balance funds and trackers?
Interesting. We actually do. We use passive funds within our portfolios. The issue with passive funds, I think, you're always on the back foot. No matter how minimal the fees are, there is always a fee. So if the fee is 0.5%, you're always 0.5% behind the market. We use trackers, we use ETFs within an actively managed framework. When we're looking at certain geographic areas, we might use a passive tracker for say some investments in Japan at a particular time. If we're trying to move quickly, we might rather than buying a particular share within the UK market, if we want to move quickly, we might buy a tracker just so that we can capture any perceived upsides in the short term. But we use them within an overall managed framework as part of the toolbox that we have available to us.
Thank you. Sandra, I've got one for you. Do you think decarbonisation and the move to net zero will be inflationary?
I think that's a very big question. It's a very important question. We've seen certainly over the recent period a big rise, not only in energy prices, oil prices, etc., but also carbon credits prices have gone up quite significantly recently. The energy transition is quite clearly something that's here to stay. We've had COP26 pointing out how much of a focus this really will be globally. A lot of effort is being put into this in the ESG space, in particular, looking at ways to facilitate that. So it is a long-term theme. Ultimately, you would think that a higher carbon price is necessary to give the right incentives to move away from the fossil fuel industry. And the higher it is, the quicker this incentive comes about. Of course, it does increase inflation if you go down that route, and that will be a difficult balancing act. And I think governments are struggling to hit the sweet spot, shall we say, between encouraging the transition and yet not stoking too much inflation and making it very hard for households. One good thing is that we are operating in an environment where households have, in aggregate terms, saved a lot of money during the pandemic. So there's actually more space to absorb some of these extra costs. That's it's quite easy to forget about, but the sums, as I mentioned, are really huge. And so there's perhaps more scope. The slight snag to this is, of course, that this is an aggregate picture. Yes, the aggregate household savings rate is one thing. Individuals may be in a very different position, and certainly some parts of society will struggle much more with that. So it's not an even distribution, unfortunately.
Thank you. Stacey, I've got a question for you.
I knew you were about to do that.
How do you measure the gender balance in your funds?
So if I just step away from private equity for 1 second, we've got a really big framework that we use for our funds. We call it the approved process, and it covers assets and philosophy. I'll not go through them all. There's definitely a word for all of them, but the E stands for ESG integrated, and the way that we look at our funds on an ESG basis is covered in that part of the framework. Now, what we do is probably a slightly excessive 14, I think it is at the minute, page questionnaire. And what we're trying to do through that is capture ESG information. At the minute, it doesn't include very much on diversity. It's actually much more focused on environmental issues and how those fund managers are really trying to assess E, S and G issues in their processes. But when we're looking, but there's definitely scope, by the way, to improve that. And that's going to be one of the things that we start asking them to report on. Where we also try and find out information is in the, let me think, it would be in philosophy, which is one of the P's, so the process. And what we're looking at is for what the teams look like and diversity within a team. Because really, really good decision making comes from people asking my favourite question ever, which is, what do you see that I don't? And so what we do is when we go and we speak to people, we take them the questionnaire, we see how they respond to the ESG questionnaire, we look at how many people are in their team, what the split is, what the knowledge is. There's a lot of work going into that, and I can only imagine that 14-page questionnaire might get slightly bigger over time.
Thank you. I'm conscious of time. I've got a final wrap-up question No, there is actually one more question that's come into the chat, so I'm going to ask it. On the ESG questionnaire, how is that validated? 80% of carbon emissions are in the supply chain, for example, but nobody is required to report on their supply chain for ESG.
That's true. So what we do is we look at how the investment manager looks at ESG in their process. So our assessment isn't on the portfolio, and we've definitely got things that we can do look through for, as in a digital solution to help us try and understand that. These things are getting more and more sophisticated every single day. You know, we get people showing us stuff. It's the amount of effort being put behind that is actually really interesting. I think our process actually looks at the managers, and what we're trying to do is to say, right, if you're a big asset management house, how are you using your digital capabilities to try and get that information as well? How do you feed it into decision making, and what can you help us with? So hopefully there's this like really big thing going on. We talked about funds and we talked about versus trackers. The really interesting thing is that funds that charge more are starting to look at how they can really justify that, and one of the ways is through giving us really great ESG information. So, you know, it's just going to get bigger and bigger, and we will be able to do that soon.